Okay, good morning, gentlemen. This is Clueless Trading Frank. Today is March 5th, 2017. This is an advanced coaching session for paid students. This session, with your permission, I will be uploading to the YouTube channel for others to get an idea what this advanced coaching sessions are all about. And the second reason is a bit selfish. We have some family engagements later on today. So I probably will not have time to do a weekend forecast like we do at the end of the week, setting up for next week. But if I do, then this will obviously remain private. Full disclosure, this is purely for financial education and not for any solicitation or advice. And let's kick off. So what the topic today is, which I thought about it last night, is we're going to do a couple of things. We're going to go through a series of platforms that we use. That would be QUODD Algo HFT platform. We are going to be looking at the investing.com platform, which I use extensively with QUODD, and we're going to revisit a platform that we haven't used recently, but I have used extensively, and Tom knows that. He in the initial days of the coaching, Tom swimming the market are very familiar with, and that's the WORDEN platform known as freestockcharts.com. And on that particular one, we are going to do some chart construction, which I think will be extremely helpful, because one of the key and most critical components of trading is when you construct your own charts. Because like they say, when you build your own house, you know where the cracks are. And the bottom line is that's pretty much the truth with anything. So we're going to do that, and we're going to arrive at a conclusion or some sort of forecast or conclusion as to what we are seeing coming in front of us. So first of all, right now, what you're seeing in front of you is a very precise and the tactical version of the SPX that you're looking at. I believe that's the screen you're on. Let me just check here. Yes, that's the screen we're on, which I've been using extensively to a large degree of accuracy, as you know. And In is also trying out QUODD like Tom has, and you can see how well these machine levels are when we are trading these charts. And that has, as you all know, has kept me very much in focus. And without these particular charts, I wouldn't know where the heck the market's going. Because when the red candles or sell programs start hitting the market, if you do not have a roadmap, you just don't know where they're going to end. You know, it's really as simple as that. And that's what happens with most traders out there. You know, they just get all crazy excited when you're seeing green candles moving higher, and they start buying at the top, and the next thing you know, there's a consolidation move, and then they get all sad and quiet when the red candles start hitting the market, and the machines are basically resetting, as we can see down here, and then they get all sad and stuff, and they start selling right down here because they think, oh my God, now we're going to really move down, and then right there, the markets turn. It's the same old story over and over again. Okay, so one of the key things that I want to mention, which you guys very well know, that we are in a topping process in the market. Just the way a couple of months ago we were in a bottoming process in the market, now we're in a topping process. The topping process does not happen in one straight line. It's not one trigger that says, okay, that's the high, and from this point on, we're just going to basically go in a straight line down. It just doesn't work like that. Believe me, I used to think like that years and years ago, and of course, I learned it pretty fast that it just doesn't work like that. And if somebody just goes completely short on the upper end of the market, which at this point is capped at 2401, right there, you can see that 2401, with a bearish engulfing big fat candle. That's the reason why I suggested having hedges and puts right on that day when everyone's like, okay, you know, you heard some traders say, oh, we're going to go to 2,500 and all that kind of stuff, because that's your emotional part of the brain talking. Right there, you got a big fat red candle, which is considered to be a bearish engulfing. Now, the bearish engulfing candle, which you guys know, means that a candle which is large, which basically is encompasses, fills the body of the previous green candle, and then and then slips below the closing price. And that is exactly what happened. You can see that clearly here, because that red candle is larger than this previous one, which was shooting higher, and then after that you see this move down. As you can clearly see here, the move down was capped at the gap fill, which I showed. That was your gap fill. That was the big monstrous move that we saw on the 28th, the big monstrous move that drove the market up 300 plus points, right? And that is an impulse surge. An impulse surge is like impulse shopping. You know, you're walking around, all of a sudden you see something that you don't need, and you just go out there and spend $100, $200 just buying that for no reason. So that's known as an impulse surge, okay? And that impulse surge in the markets happened because a good chunk of the short position that's in the market in the form of E-mini or S&P 500 put positions, okay, through hedge funds, primarily through hedge funds, just got blasted. Now, did you understand what I said, or should I explain?
Yes.
Okay, you did.
Yes,
Excellent.
okay.
Excellent, man. Okay, good. If you don't understand anything, just stop me. So bottom
All
line
right.
is that when you have an institutional squeeze like that, these are not something that you can really measure. However, it is something that can be somewhat predicted based on the type of methods that I use. As you can clearly see that when we were down here on the 28th, and this was March 1st. On the 28th, we were coming down. We were moving in a rolling wave where we seem to be finding some support at this level here, and also support at my channel, the blue lines that I drew. Okay, and that's part of chart construction. And we also notice that the slow stochastics, that's the SSOC, S-stoch right there, slow stochastics, not the fast one, which is here. I minimized that. The slow stochastic was coming down towards the red line. In other words, it was getting oversold. I expected a slightly lower, maybe a little bit lower, just to be on the safe side, but it didn't matter because right there, the following day, the market gapped up and decided to basically kill the shorts. So this type of surge, impulse surge, generally, I would say 80% of the time gets reversed. Period. Okay, because Tom knows this, but let me just explain to you know what a market maker is?
Yes.
Okay, market maker is somebody who's basically the middleman who's selling you the shares, or large market makers are selling the calls to you. So once you are basically on the other side of the picture, you are, just like accounting, your ledger balance is on the debit side. In other words, you are when they're selling you, let's say 5 shares of a stock, they are short 5 shares of a stock. Okay. So one
Okay.
second, and just give me 1 second. One of our big cats is trying to climb on my keyboard. I do apologize for that. Very unprofessional. But okay, sorry about that. So what happens is they try to manipulate the market because they have large positions in their books. And in the old days, they were known as floor brokers. On the New York Stock Exchange, you saw a lot of guys in funny-looking coats running around. And nowadays, nowadays machines do that job. So there are floor brokers in the New York Stock Exchange next to my old office. Nowadays, the machines do the job very quickly. So generally speaking, if you have an impulse move higher, you're going to see a reset towards the same move, so they can basically go flat. You understand? And at that point, when they go flat, because here they were caught, they were ambushed. Okay, they were caught by surprise. And 1 second, they were caught by surprise, and so they need to basically square their books off. So how do they square their books off? They basically short the they short the market from the highs and do whatever they need to do, and that's why the Friday generally, if the Thursday is a very big move higher, Friday generally is a reset move. Like I showed, the consolidation channel, the gap fill, whatever you call it, that's the manifestation or the move of what they are trying to do. In other words, square their books, because you're talking about billions of dollars here, not hundreds of thousands of dollars, billions of dollars that they lost because they were short. Okay, and they didn't expect the market to really surge like this, like it did here on that particular day. Okay, so bottom line is that one second. So a Thursday, and here was the Friday move. So knowing this is one thing, but identifying the exact tactical levels is really what I specialize in. And you guys see that over and over again. Is this something that is absolutely guaranteed and certain that this move would happen? No. It could have surged higher. It's happened before. But generally speaking, when you see an impulse move like you saw here, big surge, you will get a consolidation channel. Call it profit taking, call it whatever, but that's the way it works. So one of the key ways that we identify this is by looking to see the internals, if they are deep oversold or what they're doing. Okay, and at this point, it was a pretty good bet, the higher probability that once we had this consolidation channel here, starting on the 27th, that that we were getting oversold and we were going to get a bounce. Just we didn't expect this. So saying all that, you can see this chart is very clear, and just chart construction is what makes this roadmap easy for all of you guys to see, or at least have an understanding. Now, there's a couple of things here. This shaded area that I put is the gap fill. So the lower end of the gap fill has not been filled yet. That's 2364. It was looking like it was going to go there, but there were a couple of things that stopped it from going there. One was this uptrend channel, the dotted line. You both are following me so far?
Yes.
Yes.
Okay. One second. I am going ahead and just re-inputting the link for Tom. Hold on one second. I didn't want to interrupt the chain of thought. Okay, done. So for Jim, I'm sorry. So so the bottom line is that okay, so the bottom line is, so one was I'm just showing you what my eyes and brains are looking at, okay, or was looking at on Friday. So you had that channel. I'm watching this carefully. I'm watching the candles, and I'm going to make this bigger so we are more in tune with what's happening now instead of what happened all the way down here. So here we have, that's number one. Look how precise this move was. It came to the bottom of this channel. I mean, it came to the bottom of this channel, uptrend channel, the sideways consolidation channel, this one. It also intersected right there. And let me get this thing here. Also intersected right there. We also had a consolidation channel that was drawn on a continuous basis as the market was falling. All of them met right here. It cannot get any more precise than this, okay? And the only reason why it's this precise is not because I'm a genius. Certainly I'm not, believe me. It is simply because robotic machines are very, very mathematical, period. It's all about numbers. So all of them met here. So once it met here, there are two things that could have happened. We could have fallen very quickly directly down here, and this would be a fantastic buying opportunity. You can draw another, because this was a major reversal candle. This was a major reversal candle. So you can take a line, take the horizontal line and draw here. Mark this red. Perfect. So this would be a major support level at 23.53. So that was a possibility. This would be considered to, and this was S3. That's the third red line. This is S1, S2, S3. And if we broke S3, which can happen, overshoot, you can basically go all the way down towards a critical support, which would be down here. Because that, why do I call it critical support? Because one, that was a big reversal candle here of this random move down, opening low. Then we had one second. And hi, Jim. Just join in. We have In and Tom, and you can catch up on the first part when I upload it on the YouTube channel. You there?
Okay, I'm here. Yeah, hi guys. Sorry I'm late.
No problem. So anyway, In, say hello to another great guy, good friend, and been with us since the beginning. This is Fish Eyes. In Fish Eyes, we have In here. He's sitting in Paris right now, and he's one of our newer members and very, very fast learner. Very proud of it on the technical side. So you know, when you guys see each other in the chat room, you know, definitely PM and say hello. Okay. So bottom line is Jim, just to get you up to speed, we are talking about some extremely precision sort of tactical levels that occurred over the past couple of days, and why we can determine using these algo charts as to where they were stopped and why they reversed. Okay, so anyway, so we could have gone down here if we had broken that, and that would be an extreme scenario. You also have a gap fill here going back to around the 17th. All right, so you had multiple stuff here which my brain automatically looks at when I'm looking at this constructed chart of the SPX, and so you should be also prepared for that. Remember one thing about trading: because the machines are so fast and instant, lightning fast, there is no way of knowing, honestly speaking, other than a higher probability of what will happen and looking at the internals, whether they're deep oversold or not. The most difficult part is when they're starting to get oversold, they're not quite there yet. The best entry points, generally speaking, are at deep oversold or deep overbought. Those are the best entry points for some sort of a holding trade. And these holds basically can be hours or they can be a day or two. In the most cases nowadays, it's a day, you know, because then they get overbought again. That's called volatility. So the bottom line is that's the only way you can tell. So, so this channel held. We didn't get down here, and there were two other things here which supported the reversal. And I'm going to ask you guys to tell me what they are, and I'll give you a hint. They are not something that I have drawn in the chart. They are there automatically by default. What do you think they are? And,
Moving out.
Yes, exactly. The moving averages. The construction is basically my channels and the sideways consolidation or a bull flag. This is actually a bull flag. Despite all this volatility, this is a multi-day bull flag. Bull flag broke out. Impulse surge. I'm just, you know, feeding back to Jim what we just talked about. That was an impulse surge, unexpected, or what I call a white swan event. All right. You know, you know what a black swan event is?
Yes, I know.
There you go. So unexpected, unquantifiable. Well, this was unexpected, unquantifiable, white swan event. I never hear about white swans. So I made that term up. So it works well for me. So that was a white swan event, which got reversed, hit the upper end of the gap fill, tried to bounce, slipped below, held this beautiful uptrending channel that I drew, also held the breakout level. Remember, this was the breakout level of this move. Entered the gap, found support, as Jim correctly pointed out, on the 50 and slipped below the 34, this yellow line, held support at the 50, and in the meantime, this was happening behind the scenes. It's like a kabuki theater, you know? You got to know what's happening backstage. So the bottom line is that once it did that, unbelievable, it just created 1, 2, 3, 4, 5, 6 mechanical. I mean, this is like a little Lego diagram. Okay, and 1, 2, 3, 4, and it started at 11 a.m. Look below. Let me move that. Look at the time below, 11 a.m. and it just ended. That's where we ended at 4 p.m. Now, in the meantime, this was certainly from a trading perspective positive. There was a crossover. Took time to develop during the day because it's weekly options expiration, and then it had a crossover here at 1 p.m. and now it is here. Now, let me get into the reality of the thing. Just because this looks like that doesn't mean that's what it's going to be on Monday morning. There's a lot of stuff that happened over the weekend. The China news that China has reduced their growth forecast. Now they're looking at 6.5%. Don't know how the markets are going to react to that. They also did something positive. They are moving back from raising taxes on property on property taxes. So that's a positive. They're also allowing insurance companies to be more flexible. That's positive. Then you have the political back and forth, okay, going on here in the U.S. So the bottom line is, those are unquantifiable events. They're not earth-shattering, but they're unquantifiable because we don't know how the markets are going to react on at 6 p.m. today, and then how they'll open up tomorrow morning. You have to be ready for it. There's nothing we can do. And if the futures do fall on Monday morning, I want to be very clear about this. I have some long calls on the Monday S&P, as you all know. The 2385s for the 6. They're $2.35 at the close. Okay, and they're moving between 2 and 3.5. The $2.35. I'm happy. I get nervous if the calls were at 6, 7. I'm long a few, and the markets open down 15 points. They go from 6, 7 down to, tell me where it goes. Just take a rough guess. Jim and Tom know. I'm sure you guys have been there. They'll go to $2, right? Or they'll go to 1. So then all of a sudden you're just like back to the cost averaging, looking at the charts and stuff, which will be the same case on Monday. If the market gaps open and follows my roadmap, we're going to basically open up here. We have S1, I'm sorry, resistance 1 here, the green line. We have the pivot here at 2385.78. So important. Pivots, for people who are going to be listening to this, are the key. They're the jumping board. It's like when you're a kid, you're just jumping on a little trampoline. Or maybe as adults, you want to jump on a trampoline. It's called monkey on a hot tin roof. I'm just kidding. So bottom line is that I jump on a trampoline too, all right, in my brain. So if it goes above pivot, you're going to see an overshoot, and this pattern is going to get completed. There's a minor gap here, but you can clearly see what this pattern is. It's like a big cup. It's like my Keurig coffee I'm having right now, like a cup. Or it's going to overshoot because shorts will be like, oh boy, man, we can't get this market down. Okay, they'll capitulate. Maybe some shorts were entered the shorts right here, and they did not close their positions because they're still profitable. So at this point, they have stops here because they don't want to lose money. And the shorts who came down here are certainly losing money. All right, and the shorts who came down here, which I'm sure many did, because it looked like with the people who do not use this type of clueless trading, absolutely mathematically precise charts, they probably went short here because that's what it looked like, because they're watching prices. Reminder, don't just watch prices. Watch the whole picture. If you're an active trader, you have access to your screens. Don't just watch prices. Anybody can watch prices. My dogs and cats can watch prices. What does it tell you? Sure, it tells you that there's a surge up and down, but it doesn't tell you when you need to get the heck out of Dodge, sell, or it doesn't tell you when to buy. It doesn't. Those days are gone. Just want to remind all people who will be listening and who are just simply price watchers, kill that habit. Of course, watch price, because that's what creates the P&L from going up and down. But don't just watch the price, because all that will disappear in a flash second like it did. Because right now here, many went short. Not on our team, because I told people don't go short here. You can have a hedge, but don't go heavy short. And look what happened. Gap open and gap and go. We call this gap and go. And they died. The shorts got decimated. Billions were lost in the hedge fund industry, people who were institutional shorts. And then comes the nice reset. Right when they maybe, if they were just watching prices, they were buying here because it looked really, really good. And then bang, comes the consolidation channel. Same old story, back and forth. So hard warning, not soft warning. Don't just watch prices in this type of volatile markets, and volatility is here to stay forever. Not for this month, next month, forever. I said that last year, that 2017 will be the year of the rooster, right?
Yes, you did.
It's pure volatility. You guys are going to be 10 steps forward. Yes, it's not going to be easy. It's not easy for me either. But boy, you're going to handle this volatility a heck of a lot better than many members of our club and most traders out there who are just have no idea and just watching prices. Don't do it. So bottom line is right there, we have this. And going back to what I was talking about. So we could fill this minor gap, and we could fill the upper end of the Bollinger. That's around 23.99. I see a move up like that. I am out of Dodge, because if you have a gap up of anywhere more than 5, 6, 7 points, don't sit there and, don't just, first thing you do is sell, or sell most of it, because it feels great from a psychological point to make some money first thing in the morning. Look at it in a simple way. It's like you walked out the door and somebody just gave you a couple of $100 or a couple of $1,000 just as you walked out the door. It says, hello, in, how are you? Here's 500 euros. Great. Take it. So that's what gap upsells are. Now, you could say, well, there have been so many cases, that it gaps up and then just gaps and goes. Yeah, sure. But do you know it's going to gap and go? No. So sell, leave a little bit in there, or if you have a little, sell it. If you have the ability, which every trader should, mind you, because you need the ability to have cash on the side to basically go back in again and then gap and go. I mean, then you continue with the forward path. So gap opens should be sold, in my opinion, or most of it sold. Yes, I'm sorry, Tom. Were you asking something? Go ahead.
Yeah, that's kind of my question, because I did that Monday or the other day when that thing went up, that first green candle. I'm like, okay, we're going to gap up and then we're going to fade back down. So I sold off.
Yeah.
And then, of course, you look back at the chart and go, geez, with that kind of momentum, should I have just,
Okay.
gotten in there?
Let me just one second. That you're absolutely right. So two answers to that question. Very good question. Thank you. Because that's the reality of what we do in the business. So once you had this candle, there was absolutely no guarantee that we're going to continue with the further 4 more candles. Okay. That's why we call this a white swan event. In other words, it was an impulse surge. So what you basically do is look at the next candle developing, look at all the stuff that I'm putting across. Okay. Look at what's happening here, because once you get a surge like that, if you don't see it topping, because you didn't really see it topping till what you did was sort of the smart discipline thing. But discipline, sometimes it happens to me too. Because I'm so disciplined, I sometimes leave money on the table. Remember, a speculator or a real gambler takes risk, like literally grabs risk and says, that's it, I'm going to bed with you for the next 24 hours. Well, I don't do that. Okay, seriously, I don't do that. You see, sorry, this is going to be public viewing, so I really can't say much. With ACS, I'll make some funny jokes. But bottom line is, I don't do that. I will take that, I'll give it a squeeze, out. All right, it's right there. So looking at this thing here, if you look at the second candle developed, look at the time below at 10 a.m. Look what was happening down here. It was still surging higher. That's the reason why the slow stochastics are so critical in determining what will happen, and from a technical standpoint. So this wasn't even over the upper limit, or what we call the overbought zone. Then the third candle happened at 11 a.m. The surge continued. and then the slow stows are showing they clearly still want to go up, you know. And
I was expecting the slow stochastics to do what it did like on the 27th and the 21st, where it went up and made that little curve with the sell-off. Yeah, right there.
I know. So what was happening here, excuse me, you have to look at what you need to do, and it's another damn good question because it allows me to give a damn good answer, is that what was happening here, you got one huge candle, but you didn't see the follow-through candle. Candle structure is extremely important. That is momentum trading. When you see straight up candles like that, you know what's happening in the back is that billions of dollars worth of institutional shorts are saying, oh shit. Their machines are saying, oh shit. The algos are saying, oh boy, they have predetermined stops on the upside, right? So they are getting stopped out. They're getting stopped out. Just the way the next day, the consolidation, they were getting stops were triggered. Here, stops were triggered on the upside. They're getting stopped out. And so,
Well, yeah.
so what well, let me finish. So the answer to your question was if the candles are shaping up like this, and I've shown that in multiple stocks too, okay? And and these powerful, we know known as expansion candles, all right? Then you can stay long to a certain degree. You can minimize your position, but stay long. Here we had a sharp expansion candle, but no follow through.
Look at the 21st.
The 21st we had
There you go.
okay, yeah. So let me go back here on the 21st. So the 21st, this started at around 3 p.m. Okay, then it gapped up the following day, which was at oh no, I'm sorry, 21st, this was at 9 a.m. First candle, second candle. Yes,
Yeah.
you were absolutely 100% correct in thinking that this was going to be the case, that there was going to be a pullback. That is why I'm saying we can't determine what will happen in the next 15 minutes. We can only act and follow. So the third candle did not create this third candle, okay? And the bottom line was that this would have been the normal pattern, like here, and then move up. But there was other stuff going on. Remember, technical analysis alone cannot answer 100% of your of what will happen. Nobody was expecting this. This only happens, I repeat, it's an unusual event. That is called, in some cases, we call it a blow-off top. Okay? Like just the way in many cases we have seen crashes where we have and we have seen those a lot, where you have blow-off bottoms because the sell candles, the red ones, just keep on going like this, the volume surges, you know, and then that's where the bottom is created. Here, that is exactly what is going on. This, for now, is a major market top, the 2402 level. I'm just laying it out. We had a double barrel bearish engulfing reversal, and I've read many of the technical analysis, and I'm posting some of them as I'm going through them, okay, which have called that event back last week where we ran into the 21,000 plus level as a blow-off top. So on a blow-off top, it's a climax, right? It's a buying climax. You understand that term, In?
Yes.
Okay, so a buying climax is where the shorts just get pummeled, and some of the newer money gets pushed in, but primarily because large shorts, billions of dollars, are just getting have to cover. And a blow-off bottom is just the opposite. So this was a blow-off top. So don't worry about too much, Tom. What you did was the right thing, because yes, you left it out. You left a bunch of money on the table, but at the same time, this is all about risk, unknowable risk. So you could just have left a little bit out there. I'll talk about that later in the thing, that this type of market, you will have to trade unknowable, unquantifiable risk trades, long and short, a bunch of times, where you just, like they say, you know that old saying, the greatest rewards in life are when you sail the ship out in the ocean and you can't see the shore anymore. Okay? So,
Now you sound Moana.
well, you know what I'm saying? You can't see the shore anymore. Jim does that all the time. Just kidding. So, bottom line is that so that's what happened there. So that's an unusual moment. Don't expect those type of blow-off tops too often, but it's been happening quite a bit here and there. So that's just the nature of something that I talked about years ago, that the majority were bearish. And this is the result of that happening. Majority institutions, majority retail, regardless of what they're saying out there, are short the market or market neutral. What does market neutral mean? Nobody is neutral in life. You always have a decision. I mean, you always have an opinion one way or the other. So, so market neutral simply means they're scared and they're sitting on the sidelines. What does sitting on the sidelines mean? Lots of cash sitting on the sidelines. So they're forced to come in. So bottom line is, this is the result of that happening with these surges, where the market, it shocks me in a, you know, I'm at 21,000. Next thing you know, it could be 22,000 with this type of surge, because that's what happens when money gets forced in from the sidelines and the shorts get blasted, you know. And you don't really hear too many people on the media talking about that stuff. Yeah, that some of them talk about it, but that is the reality of what's going on. And of course, all this is happening on the backdrop of a very positive business environment, the great climate created by the administration with a lot of the business deregulations and stuff like that. Many reasons. Okay, and that's it. So let's go back to this here. I don't think that we are going to see 2402 immediately. If we do, oh boy, this market's going higher. Because if we do, and remember, and this is very important what I'm going to talk about right now. If we get this, if we go up here, that creates the cup. Maybe it'll create a small handle. That's what a cup and handle looks like. Pull back a little bit. And then if we move up, then we have an upper Bollinger resistance here, which is pretty close to what the previous high was. If we blow through the previous high, my charts say it all. We are going to basically go to the upper balance of where we the two dotted lines, the wide uptrending channel, and that is going to be around 2412. I think that is going to be the max move for this week. Max move on the bullish side. Because once we get here, we are going to be, like I explained earlier, you're going to see a reset. That reset could bring us down to 2390 again. It could bring us down. Remember, this pivot was Friday. It will be readjusted tomorrow morning. So it'll probably be up here. Or it could be down here. I don't know. The machines set the pivots, and that's why I love the pivots on this QUODD Algo HFT platform, because they give me the exact path road first thing in the morning as to what I should be looking at for real danger signs or real upside movement. Above pivot, good. Lower pivot, bad. That's it. And then all my lines and stuff like that. So bottom line is, we got a Bollinger here, which is right now, to be honest with you, what does this Bollinger directional trend tell you?
Down.
There you go. Good eye. Down. Correct. The wave is down. The second negative that I see in this chart, can somebody tell me what it is? On the actual candles, candle patterns. What is the second negative? Think and answer. I know you guys know the answer. Now, In might know the answer, but I know you two do. Look at the focus on the this area from the surge.
Making a bear flag right now.
Thank you, Jimbo. Okay, sorry about that. I get excited when I hear Jim speak. Sorry, we're having a bromance here, okay? But we've had a bromance for a long time. So all right, yes, sir. Exactly, exactly. This is a bear flag for now. This is a bear flag. A bear flag is this. Now, the bear flag can break out, as I explained, on this cup type of pattern if we gap open, and a bear flag can break down. Did you get that?
Yes.
Okay, good, good. And I'll tell you guys, you know, and this I always love, like they say in life, you know, there should be credit, there should be a positive encouragement when it's due. And for somebody as new as to come in and pick up things so fast makes me and you guys, this is what Jim and Tom were months and months ago, is it just makes me excited, because it means that what the work that I'm doing is not only being respected, but is being very aggressively soaked in and absorbed and understood. And that says that all the hard work that I do for everyone is nothing is a bigger respect than somebody picking it up fast. That's it. I don't make any money off it, but the better off you are in understanding what I do, the better off you will be doing for yourself. So everyone else who will be listening to this, remember, I don't do favoritism. He's not my teacher's pet. My only pets are my 2 dogs and 3 cats, and those are and those are rescues. All right. So bottom line is, I'm not here to rescue anyone, but focus, respect, understand. It's just going to help you. And that's why I stay so strong, and sometimes I sound real tough on the chat room when people are just looking at the simplistic things, pricing and what the what's going on and their emotional thoughts, which is all fine and good. We're all emotional beings, but try to focus on this stuff. So good stuff, man. All right, so it's a bear flag. So what does a bear flag do? Let's look at that scenario, what might happen on Monday. Because like I said, we don't know how the markets are going to react to all the developments over the weekend. One of the things I talked about, Jim, you might have, I don't know what if you stepped in when I was talking, we have had some positive and some negative news coming out of China. The Chinese Congress has met over the weekend. It goes on for 5 or 6 days or a week. Lots of important developments. If you remember back in the days, people were, the media was glued to what was coming out of the Chinese big plenaries and their Congress. And they lowered their growth forecast to 6.5%. Nothing big. They said 6 and 7% anyway last year, but depends how the markets look at it, what the tea leaf reading is. Then they did some positive things too. They loosened the strings on insurers to expand more. Property taxes are not going to be increased or curbed. So bottom line is, that's one. Then we have political developments on this side. We don't know how the international markets are going to take that. So there are unknowns. So this is where we are, and this is certainly positive. But this all of a sudden, being a bear flag, can go like this. So at that point, the rest of the world, the rest of the trading community, oh boy, here we go, this is the big one, and all that garbage coming in. All we're going to be doing is satisfying the first requirement, which is the lower gap fill, which also coincides with this blue line here, constructed blue line, which is the trading band or the sideways bull flag that broke out last week, right? We tested the first part. Now it's time to test the low part. So we could actually gap open lower here. If that's the case, that's going to be one heck of a gap open lower. It's going to be it will be 20 points. And a lot of non-technical, non-clueless traders will be opening up a new pack of adult diapers. Okay? Do not do that. Bottom line is, you got one gap, you got the lower gap fill that hasn't been satisfied yet. The upper one has. They also have a gap here. And that gap is this very important and critical support level. That's 23.52. We closed at 23.83. So if we gap down that fast, that quick, you are going to get a reflex bounce, which will move like this, and try to get to the to this channel, this sideways channel, consolidation channel that we broke out of. Try to get there. So this move alone could be some substantial money on a reflex bounce, or it could basically try to. There is a little gap here, and this is what technical analysis is. You know, you can just run away from it. There is a minor gap here. You can see that. Let me clean this out and show you all. There's a minor gap here. So this could do this, fill this gap here, right there. And then we have a lower gap here that I was talking about, which would be something that the market could bounce off. Or we could just come down, fill this minor gap here, which also is very close to the, it's pretty close to the larger gap fill. So this zone is in play based on this bear flag, which might play out. Now, if some of you have bought some puts to hedge the UVXY, remember I alerted that. I have the UVXY. That'll basically, which the UVXY was down about $1.30 or so on this reversal 1, 2, 3, 4, 5, 6, 7 candles that started at 11 a.m. on Friday, but I left a hedge out there. That's why it's a hedge. It's an insurance. You know, a hedge is an insurance, or it can be a full-fledged trading vehicle if you see a definitive turn in the market. And I keep on showing that the top is a rolling process, not a oops and then crash 1,000 points. Now, the 500 plus type of points, it's coming. It's coming. But we'll keep on tracking these charts to give you that trigger. So bottom line is that would be the downside scenario of the thing. The 2350 level would be considered to be a substantial drop because we went to 2400 and we're losing 50 points to 2350. That means we would have lost, if we get down there again, we would have lost roughly 300 to 350 points from here to here, which would be a nice reset. Because like I said, the monthly forecast for the end of the month, after the turbulence we see in the middle of the month, remember I talked about it in my previous video cast, so please, I'm not going to keep on repeating the same thing. But after the turbulence that comes, give or take plus minus 2 days from the 15th, you are going, they will try to close the first quarter of 2017 in the U.S. financial markets on a strong note. Period. Like Sean Spicer said. Just kidding. No, seriously, that's what they're going to try to do. That's what the fund managers will try to do. So we're going to be watching this. So that is the short-term forecast of what's going to happen in this coming days. And so if this bear flag basically keeps on getting rebuffed, it goes to the upper end of the channel here and then can't move higher, can't break into this gap. This gap is a sell, number one. This reaching to the top, upper Bollinger, sell. Because we want to see how the markets are reacting. And if this thing goes, gaps open up here, let's say 6, 7 points, I can bet you that by early Sunday morning, early Monday morning, you're going to see the slow stows back here. And once the slow stows back up here, you don't want to be aggressively long. It will reset, period. And if we gap down, then the slow stows, which are looking like this, and if, by the way, people who will be listening to this, because I did ask permission, and Jim asking you too, because we have some important family engagement later on, so I might not be able to do the weekend forecast, so I'll be uploading this for people to basically soak in what we're talking about. Is 1 second here. This slow stow will simply take another tumble. Another tumble down here into these levels that I just showed creates what? And what does it create? If the slow stows do this again, what pattern is this in?
Double bottom.
There you go, double bottom. Like that great song from Queen, Fat Bottom Girls. All right, just kidding. So must be this coffee this morning, or maybe the cold. I don't know. I don't want to be silly. But bottom line is, yes, there you go. Then you create that. That, by the way, if we do this based on what I showed, one level of contact here, you could see a massive surge from that point, because generally double bottom reversals on stochastics are powerful buy triggers. Just the way a double bottom or a triple bottom on individual stocks are powerful buy triggers, that's exactly the case with the stows. For the internals, it's doubly powerful. It's doubly bigly powerful. How about that? All right? So we'll see. So both scenarios are in play here. If you gap open, don't get all super excited. Sell. Use discipline. Discipline will keep you alive. In war, in life, and in trading. And these Bollingers are sloping down. We shall see. These Bollingers were, you know, well, I'm not going to do Bollinger studies right now. That's it for the quad thing. And that's the SPX version that I'm showing. I'm going to quickly scroll and show. We're going to switch screens in a minute. We're going to show the 1 hour, which is on the SPYs, shows you a slightly different picture. This is more methodical. You can see here the range breakout. This was the range breakout. This was your range right here, right? This one and lower range, 235, 237. On right, I'm going to take a quick second to stress and make it a point that traders who want to make serious money, whether they're part-time traders, whether they're full-time traders, doesn't matter, okay? At some point or another, now or sooner than later, have to subscribe. They should, for their own benefit, subscribe to the QUODD Algo HFT platform, and believe me, I don't make a single penny off that. I have no connections with QUODD. It's an independent company that supplies hedge funds and Wall Street with their platforms. They have a reduced rate. I've talked to one of the partners that they give a very reduced rate. They give to Clueless Trading members, because I've sent a bunch of people to them, and you guys need to use this, okay? And because there's no way in the world you will have predictive or effective trade management if you, and more so for active traders than anyone else, more so for active traders. And I cannot tell you how important it is, so that you can not only make your own determination, but you can understand 100% of what I'm putting across. That itself, you'll be hopefully seeing the world, the markets, through my eyes and brains. Well, you can't really see it through my brains because I really am kind of clueless, okay? I rely on my stuff, my tools, to make determinations, because I ain't that smart to tell you what's going to happen a month from now. And even if I was, I wouldn't tell you. I'm just kidding. All right. So bottom line is that you see the gap here. So the bear flag, if this is a bear flag, then of course we're going to fall into the gap. And once we fall into the gap, it's not just going to just stop there. It'll most probably slip here at the 236 level and create a, possibly create a large movement, or come down here, create a movement. Now, saying that, I've already posted a chart on Twitter, which people should look at before the opening, because that was one of the last, I'm exhausted on Friday and then still put this out, chart, end of the week charts or the end of the day charts that I put across. And I'm going to remind people, and it basically was a scenario of what might happen as we open the week. So bear with me 1 second. I'm bringing it in here. There you go. Bingo. There you are. Look at this. I've already showed what the first level of movements are. The next level of movement would be down. Sorry, let me get this line. A big drop would be down here. And this is the other version of looking at it. Same thing, right? Would be where this major support, and then we could possibly move from here. But look at these arrows and look at the different scenarios which I think will play out. This scenario for the bulls would be fantastic. Okay? This first one, like that, which would be like, man, this Clueless Trading Service is great. I just nailed it again. You know, when you start thinking like that, that's going to be the end of you making money, all right? Because I am not great. I am just trying to help people become great. How about that? So when you get too excited with my service, that means you're getting too lazy. I know it's an old-fashioned way of looking at things, but that's how this country was built, not on laziness, on hard work. So use your hard, I do all the hard work, use the hard work of understanding what I put across. That's the reason why I'm doing this on a Sunday morning, all right, for everyone to listen to. So bottom line is, so that would be great. And you sell. You just sell, 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 sell. The second is we open down. This is the scenario which I would like to see. Why? Because the moderate amount of S&P calls that we have, which is in the $2 to $3 range, will come down to $1. You jam in and buy maybe double up more or triple up, whatever the case. You see this turn and it gets up here. Doesn't even have to get up here. By the time it gets up here, that's the breakout. Guess what? You've just you just doubled your money. And if it gets up here, it tripled your money. Because here, you might have, let's say, I'm giving you hypothetical examples. Let's say, for example, somebody has 4 calls at 2. Smallish amount, that's fine. Okay, 4 calls at 2. It gaps up open, those 2 becomes 4. They're like, man, just doubled my money, and you sell. If they fall down here, they have 4 calls here. You buy, let's say, another 4. All of a sudden, you have 8 calls, and your average cost is now 1. Or let's say your average cost is not 1, average cost is now 2. So your average cost here is $2. Believe me, this is the reality of what plays out every day. And without my charts, you wouldn't know what a cost average or what to do. Well, I do put alerts all the time, so you'd know. So now your average cost is 2, not 4. And then it surges off all these levels that I just talked about in the past, past whatever, half an hour. It surges. That too, at this point, is close to 5, if not 6. Or even if it goes to, 5, if not 6. So not only do you have 8 calls now, let's say they go back to 4, you're cleaning out, you know what you're cleaning out, okay? 3K plus. Not rocket science. I'm just saying probabilities of what can happen. Here you only had 4, but you doubled your position and lowered your cost. Doubled position, and this applies to the to short trades too. So you doubled your position because the initial positions always have to be moderate. Period. That's called scaling in. So you doubled your position. Okay, I'm saying P. Or POS position, and you lowered your average cost. I'm calling it AC. I can tell you how critically powerful and mind-bogglingly profitable this simple method can be. I know there's other services that keep on telling you, you should never cost average, it's terrible. When something is down, you cannot cost average. Bull crap. If you are playing volatility, how can you not cost average? That is the nature of volatility, to bring things down, surge it higher. And the only way you can figure out that volatility here at Clueless A Trading is probably the only service that shows that as well as anything else is through all the internal alerts that I keep on showing. The better you understand my charts, the better off you will be. Period. You stay emotional, you just remain a atypical price watcher, you're back in the old days and you're really just chasing. And chasing in general doesn't make money or the real money. End of story. It's not easy. Chasing is easy. Ooh, prices are going higher. Let's go. Monkeys chase. Lions wait, plan. And then they don't chase. They just jump on their prey. That's tactical trading. Chasing? Go ahead and do it. Of course you got to chase at times. That's part of the game. But just randomly chasing prices without knowing any of these structural charts and internals is pure stupidity. I can't say anything more. So bottom line is, you're just feeling fantastic, and that's how you develop as a real trader. All right, let's take a look at So again, end of the day charts, very important, review them. So here we have the same structural pattern. Here we are noticing on the 1 hour that it is starting to get overbought. The SPX not, the SPY yes. Can somebody give me a basic reason why this is showing more, heading more into getting towards overbought zone, and the other one was the SPX is just starting to come up, same time frame. What do you think the reason might be?
I'm looking
Because
at the
this is an
moving average.
index.
Yes, it's an index. You're right, but you're close. Tom, what were you saying?
I was looking at the moving averages are different.
The moving
Looks like-
averages are slightly different. The moving averages
Yeah,
are slightly different.
crossover.
Here's a minor crossover here. This
Yeah.
is a minor crossover, believe me. And the reason it's a minor crossover is because you're looking at 8 p.m. at the bottom.
Okay.
You're looking at 7 p.m. here. You're looking at 6 p.m. here. You're looking at 4 p.m. here. Okay, but that is getting close to the answer. Why do you think so, Jim? Jim, you there?
I'm sorry, I just stepped away for a second.
Okay, what the question was this, that when you look at the SPX, look at the slow stows, much more cleaner lines, everything, right? But more importantly, look at the slow stows. It's very bullish, crossover here, lots of room to move higher. The minute, and again, this is an hourly SPX index. On the SPY 1 hour, it's the same picture. It's the same picture, but slow stows are more advanced, and the Bollingers are a pinch Bollinger, which I consider to be positive. This is not a pinch Bollinger. This is sort of a wide Bollinger. Why do you think that in this on the SPYs the slow stows are more well advanced, more of a indication on the Bollingers? Why do you think the difference? The answer lies within the fact that one is a index and one is a, what is the SPY?
Derivative of the SPX?
Yes, and they say ETF. It's an exchange traded fund, right?
Yep.
So the answer is that when you look at indexes and you look at exchange, and this is a little bit more advanced, and people need to get advanced, is one is an ETF. There's more volume. It's more, there's more back and forth, buying and selling, than the SPX, which is a reflection of the ETF. The SPX is not, bought and sold. The SPYs are bought and sold. The contracts on the SPX are bought and sold. Got it? So this is more liquid, more volatility, little bit more zoomed in. Got it? That's the reason.
Yes.
Yeah. All right. Let's move on. Now remember, all these for quad users are on pre-post market data. If I remove this, bingo. Now you're seeing what we saw on the indexes. Look, forget about the chart. The chart is the same. Look at the bottom. See the difference? Yeah, that's good stuff. I like seeing stuff like that. But now the minute I put it pre-post market data, that includes the craziness before the market, that includes the after hours trading. The minute I do that, it's doing this. I use this more, but I also keep an eye on taking out the after hours and the the pre-market to get a cleaner view. What happened here? Jammed? Okay, it jammed. Fine. Because its machine basically told me we're done with the algo charts. Let's move on. Let's now look at, I'm changing screen monitors here. So let's see. I am going into monitor 5. Bingo. Tell me if you guys can see this.
Yes.
Got it.
All right. So this is a 1 hour chart. I use this extensively in tandem with my other stuff, and this is very clear. I mean, it's really like clean, easy on the eye. White background, green lines, red lines, blue lines. Sometimes I'll put purple lines. I don't know what the hell I'll put. But the bottom line is it's easy to read. All right? Easy to read. I put this every morning, and I show it during the day too. Now, this is a reminder to all non-technical, lazy traders who are never looking at charts, or who are looking at charts but have no idea what they're looking at, not because of my fault, but because their brains are too stubborn to understand. I cannot keep on putting charts every 5 minutes. So if you have a screen in front of you, or screens in front of you, or even on your iPhone, please, for God's sakes, look at it. You match it up with what I'm doing, you're in a much better place in trading than you are just with by just staring at the prices. So remember that. I put a lot, no service out there. No service. I mean it. Puts real-time tactical charts, not just real-time charts. I could actually just post real-time charts all day long with no lines, nothing, no indicators, nothing, you know, just like put it out there. That'd be great. I'll just leave one of my I'll just leave the what do you call Twitter Periscope on one of my screens. Real-time chart, great. No, I structure it even in the midst of heavy volatility so people can understand exactly what the roadmaps are. So the key word is focus, respect, act, and you're going to do much better. And that's a great piece of suggestion, I should say. Not advice, it's suggestion to all of you who are non-chart people and keep on making excuses every 5 minutes. Okay. Saying all that, and last thing I'll tell you, it's going to benefit you more than it's going to benefit me. Because, like we say in New York, you ain't paying my bills, buddy. All right? So there you go. So we have, by the way, we have a lot of New Yorkers on this session here who are attending today. So they'll all back me up. My buddy Jim, my buddy Tom, and Rip just joined us. Rip, you can catch the first part of this intense ACS on the YouTube channel, which I'll upload in the next hour and a half or so. So as New Yorkers, we know exactly. Don't forget, a New Yorker is running the show, okay? So that's the way it works. So if you want the ultimate stuff, don't mess with us, New Yorkers, please. Because you're not going to win. So bottom line is that let's look at this channel. Let's get serious for a minute. So you got channels here, very clear. You can look at this. The quad thing is very specific, very algorithmic, very robotic. This is very clean. This is very clean if you just want to look at it. And when I draw these channels and stuff, I would say a good 90% of the time they're within that exact range. So you got this, and then we can look at a 5 minute to see the noise. And noise or no noise, I have no idea what this is. But noise or no noise, the 5 minute is you have to expand it. But I look at the 1 hour mostly on this. It gives me a pretty fantastic view all the way from down. You can move it up. I mean, I do all this stuff for you guys. You guys just have to keep an eye. So let's say we used to be down here back in the good old day. I mean, back in the bad old days, the markets were all the way down here, right? And what was down here? And remember, this is dynamic. It's free. Investing.com. Investing.com. It says Tesla here, but it's not a Tesla chart. So this was the range we were traveling in back in the days of the 12th of January. Wow, so long ago. Where were we? 2248. 2248? Yes, 2248. So keeping things in perspective can help a lot. Like this, you got to know history in order to understand what's happening now. That's in life, in politics, and in trading. So this is the history of what's going on. So you can adjust the lines a little bit like I do. And it gives me a pretty clean idea why not to freak out, which I don't freak out anyway. I try not to freak out in life or in trading. So all of you should practice that too. But I'm sure most of you are much stronger people than I am. So I will leave it to charts for now. So look where we are. Forget this consolidation channels. Take this one out, not relevant. You see, charts become a passion when you make real money on them. Otherwise, it's just like all mumbo jumbo, technicals, you know, clueless a trading, blah, blah, blah. It's not blah, blah, blah to me because it makes money. And it makes money for a lot of you. That's why it's fun. Besides from that, it's just a bunch of squiggles, right? So if you look at the longer term picture, I say longer term, it's only January. In the old days, longer term meant years or at least a year. So we are looking at, let's look at all the way to 2017. So this is 2017. This is where we started. Right there. Right there. So please focus. So let me take this line out. So bear with me 1 second as I construct this a little bit. This was that the megaphone pattern that I drew. I'll take it out for now. No, I'll leave it in there. So 2017 is here. This is a very important line. And I think we're good to go. Wait 1 second. This blue line in blue is the big breakout that happened on the 9th of February, which was 2298, which is roughly 2302, or call it 2300 for the S&P 500, which is a very critical level, not only because it's a round number of 2300, but because it was a major breakout. This was the wide channel that we were traveling in with a intermediate. There you go. Broke each one of them. But here is something I want all of you to concentrate in. Just allow me a few minutes of your time. This is the megaphone is a little bit too pronounced here, so I'm just going to leave it out. Okay. So let's start this journey. Here's 2017. Bingo. Let me get the pen. 2017. So we started here. Once you understand this chart a bit, you'll understand how to handle this market. Well, you won't understand how to handle this market, but you'll understand a little bit better than what you do now. So 2017, we jumped up, moved sideways within a wide band, 2276, 2248. That's a wide band. That's 30 S&P points, roughly 150 to 180 Dow points. That's what we traveled in, okay, all the way till the surge, the first surge. That was on the 24th. So the surge took us up into this level here. At that point, the blue line wasn't drawn because we didn't know till we saw a bunch of days and it went back to, you know, and then I could draw that line because now it becomes a point of reference because that's where the reversal happened. It tried to come back into this lower channel. Let's call this channel 1. Let's call this channel 2. And then we're going to talk about upside channels. So this first surge happened, then it pulled back, stayed within channel 1, and then went back, surged back into channel 2, moved sideways, and this is the face of volatility. Moved sideways, and believe me, the bears were here like, okay, we're finished, we're going down, it can't go higher, the market's at 2300, you know, it's all over. In the meantime, pull up my video cast. I showed that we would possibly, we could on the more swing time frame, on the daily, weekly time frames, we could possibly break out to 2320, 2340. I was very clear about that. And it's exactly what happened. Then the big surge happened on the on the 9th of February. Please remember that date, 9th of February. Which reminds me, does anyone know why March 9th is a extremely critical day in U.S. financial history? March 9th, which is Thursday. Does anyone know?
Isn't that around the time when we bottomed out in 2008, 2009?
Yes.
Isn't that depth ceiling?
Yes. Wait, I'm sorry, what was that? Isn't that what, Rip?
The depth ceiling, isn't that the day to analyze the depth ceiling?
I said, why is it an
Yeah.
important historical point? So the first
Okay.
answer is correct, but your answer is more correct because, exactly, March 9, 2009, give or take sometime during the day, me sitting at my desk, my team around, good old Wall Street, we can't wait to go out for drinks after 4 o'clock. Markets bottomed. The S&P 500 was somewhere around 666, 667. Was the devil the algos? We don't know yet. Maybe we'll find out when they release the tapes. I'm just kidding. All right. Bottom line is, yes, March 9, 2009. 8 years ago. Ooh, the number 8 again. The 8th-year anniversary of this monster bull market with monster corrections along the way, with the fact that 90% of Americans, institutional and retail or more, never believed this was a bull market and still don't believe this is a bull market. They're starting to believe it's a bull market. It's the 8th-year anniversary, gentlemen. Tie in with the fact that the debt ceiling thing starts, the back and forth. And believe me, I don't think that's a big deal this year. That's just my opinion. We got the Republicans controlling both sides. Thank God. Okay? It's fine. Yes, there will be warfare, political warfare, but that's democracy. It's fine. So bottom line is, it's the 8th year. Number 8, March 9th, 2009, when it was, they were just like, it's over. And the market went up a little bit, went up a little bit more. Everyone's like, oh, it's just a dead cat bounce. Everything's going to crash and burn. We're going down to 1,500. I mean, we're going down to, we're going down another, couple of hundred points. Garbage. The rally kept on continuing. Nobody believes. People still don't believe. Because it's all hot air, right? Great. Well, the hot air made a lot of money for people who remained invested or at least played the market on the upside. End of story. So bottom line is that at this point, the date is mark it on your calendars, on your Apple, iCalendar, on your boat calendar. I don't care. Just mark it. The bottom line is that this is where we are. So when you look at this quick channel view, and this was the surge that, let me just continue with this so you guys understand. So we have this surge here, takes us into the rising uptrend lines. At this point, I'm not drawing channels. I can draw it, but there wouldn't be any reference point. What do I mean by that? One second. And this is so important because this is what controls your trading on a daily basis. The only I can draw a line here. There. But my point was the reference point here. Here I had a reference point. There was a breakout. Here I have no reference point. It's just like nothing here. So I would rather stick to the uptrend line. So when you look at the uptrend lines here, you can clearly see, and I post this a lot, different versions of this. We are still on the mid to higher channel, right? Rising. So unless we break this, and this is really as simple as it gets, unless we break 2350 or so, this is 2351 on the E-minis, which is roughly 2355 or so on the S&P. Unless we break this, then we have a little drop to 2300. And that could happen pretty fast. So unless we break this convincingly means that the big fat candle and all internals just remaining weak, then we are okay. That's exactly what I explained, and just showing you how all these things match. That's exactly what I explained in the last 45 minutes to an hour as I was explaining the algo charts. This level is important. At this point, and then we can come down and test 2300, which I showed before. in different ways, could be a sizable bounce from here. And the 2300 is also the breakout level. See that? So that's why these charts are important. They're clean. They show the channels. They show how to trade. And I show this on stocks too. Not that hard. In fact, quite easy. All right, last part of the segment. I will go back to I'm changing screens right now. So we are going to monitor number 6. Monitor number, 1 second. I have to hide the bookmarks because otherwise you guys are all going to know that I was in touch with the Russians, okay? All right, it's a joke. 1 second. Why is this? Bear with me 1 second, guys. I'm just setting it up. In the meantime, you can ask me a quick question or two if you'd like. I'd be happy to answer. No questions yet, right? Yes? No?
No.
Done. Okay, you there?
Yep.
Yes.
Okay, good. So we're going to talk about chart construction a little bit, all right? And this is a platform that I have used extensively. My good friends here, Jim, Fish Eyes, and Swimming the Market, we have used this. And lately I haven't been using it, so I kind of missed it. So I said, let's go say hi to the freestockcharts.com, which is a version of WORDEN, W-O-R-D-E-N, and they have great charting too. So I had used to have a lot of constructed charts here, which I still do, but I'm going to show you just from how you guys can do it. So this is basically simple high-low bars, simple line bars, and these are also sometimes quite effective in trading, as I've shown. You know,
It's still investing.
Yeah, we're still investing.
What
The
is it?
screen didn't switch. Screen still says investing. It didn't switch over to Warden.
Oh yeah, sorry. Oh good, so you didn't see my Russian contacts on it, sorry. Hold on 1 second. Okay, there you go.
There it is.
That's good, guys?
QQQ.
All right, cool.
Yeah.
So we're good. So this is basically just the line charts and expansion bars and stuff. These, I used to know some amazing traders who just use this. They never didn't use candles. They're like, nah, too complicated. They just use this. It's really cool stuff. So let's take a look at, and this is the simplest version before candles became popular. So here's your Dow Jones Industrial Average on a daily. Here's the surge. Very easy on the eye. The surge on November 9th. When a New Yorker got into office, this is what happens. All right, just kidding. And this is where we are. So let's look at some simple wave stuff here. Call this wave 1, I would say. Wave 1. Sideways consolidation, wave 2. Wave 3. Look at the size of wave 1. From 17,900, call it 18,000, all the way to almost 20,000. Sideways consolidation before it broke into the 20,000 range. And here we basically have a breakout level of 20,000 to 21,000. If you look at the size of this without measuring it too much, this is wave 1, sideways consolidation, call it 2, and this is 3. Now, even though it says daily, this is really a monthly chart, in my opinion. So this is coming towards that level here where you have that topping process, in my opinion. And then you could have two things going on. You could have a sideways movement like we had here, which means that we're going to move between 200 to 300 points back and forth, and then possibly this would be wave 4, and this could last for a month. and or weeks, just the way it did here. This lasted from December all the way through January. And then we create wave 5. Now I know I've been talking about wave 5 on my service, where it is basically the sort of the euphoric stage, complacency stage, but that's on a smaller scale, time frame, on a different time frame. So this would be a larger time frame. And wave 5 could be the one which possibly takes us higher, or God knows what's going to happen. I don't know. But at least for now, what I can see is I'm going to draw some lines, chart construction. Wait 1 second. Like they say in life, sometimes keep it simple. And then it says stupid. It's called the KISS principle. Okay? So the KISS principle tells me that we could come back and retest this very powerful uptrend line in the market at somewhere around, because remember, it's not going to be a straight line down, right? It's going to kind of like somewhere around 20. I would call it around 20,800. Wow, there's a gap. The gap fill itself is 20,800. So give or take, we're coming in for roughly a 200 to 300 point fast landing. Once this uptrend line breaks, then we talk different stuff. So chart construction says you can draw it like this. Then you can take 1 second there. And this is for complete beginners who don't know how to draw lines on charts. Or for advanced traders who are just lazy and stubborn never to draw a chart. So applies to both. All right. So 1 second. Yeah, that's good enough. Let's do this, baby. I was trying to draw a rising wedge, which I had shown previously. See, now things are coming into structure. Once things come into structure, you know what you're doing. 1 second. This is a big fat bullish channel. Like I showed the other day when the market was up 300 things. It's called off the charts. That's a big technical term, by the way. It's called off the charts. That's a joke for guys who didn't get it. All right, like off the charts, to the moon, all that type of heavy duty technical terms. Okay. 1 second. What I'm basically doing for people who want to focus on chart construction, I'm trying to see the maximum engagement points or contact points as I'm drawing this chart. Can't be exact, but I would say, let me just put it here. Yeah, that's good. That's good. So I don't want to draw any more lines. So when you look at this, did it freeze? No, it didn't freeze. Okay, good. So the highest we can get to on a real surge is simply the upper end of the channel. That's 21,700 or 21,680. That's another 580 points from here. That's roughly another 100 S&P points. I highly doubt that on this move, but what the heck do I know? Okay? That's your sort of upper end of the channel where things are just fully valued. Because right now, we have swath of sectors in the market that are far from 52-week highs. What if they get there? Can somebody tell me what one of the sectors in the market which has a lot more upside to go haven't caught up with the underlying asset? I've already given the hint. I repeat, hasn't caught up with the underlying asset, and that sector is well off their 52-week highs and just starting to bottom and go higher.
The XLE?
Thank you very much. The energy sector. Period. The energy sector. Exxon. Prime case. Those stocks, what if those stocks, which are a solid 15 to 20% of the overall market, start an intermediate rally? We can get 500 points in the Dow within days, within 2 days. What if? Now, without extending it further, what is happening next week in Texas, in Houston, the oil capital of North America and the oil capital of the world? What's going on there? Aside from a lot of rodeos and strip clubs, what else is going on in Houston? I'll enlighten you guys. OPEC, aka the Saudi Arabian monarchs, the kings, the trillionaires, and the US oil industry, and the Russian oil industry, which is huge, if you didn't know, are meeting. We're meeting for first time in a long time. They're meeting on the oil trading, oil producing capital of the world. Used to be Houston, Texas. Okay? Next week. You think they're just going to talk and bring the price of oil down? I doubt it. Will they shoot up oil $10? I doubt it, but they're going to say some positive stuff. I'll tweet that article out. I just saw it. I didn't know that was coming. I'm not an oil analyst. I just chart it here and there. So I thought that was pretty big info. All right. So
Hey, Clue.
Go ahead.
When is Aramco IPO?
I don't know, but it's coming on New York Stock Exchange, and some people are going to make so much money that they don't even know what to do with it. That's business. That's why the Saudis never get slapped on the wrist, because money talks and you know what walks. Yes, you're correct. Saudi Aramco is going to be the biggest, bloated, fattest IPO in U.S. in financial history, and everybody's going to buy a piece of it. I'm not, because I don't give a crap. Okay, why should I buy Saudi Aramco when I can trade on my oil stocks and make money? But it is going to be huge, and New York Stock Exchange has is the biggest underwriter of Saudi Aramco, and that is huge. Makes Snap look like a little puny, nothing. So a good point. So I'm sure they're going to be talking Saudi Aramco and stuff when they're here. Not that they don't talk. So anyway, saying all that, you see what the channels are. If we break the red line here, which is 20,600, we're in trouble. We're not in trouble because we're going to be short. We're going to be short in many different fronts. This gap here at 20,600 is the first real short trigger. The mild short trigger is here at 20,800. If we don't hold this, we're coming down here. 20,544. These are so defined, it's not even funny. This was that rising wedge which broke loose. So that's, the breakout level is here, 20,000. We know that. And this was the second breakout level over the rising wedge. See you later. What we call the big fat short squeeze. Not that it's not been happening since 2009, but this was humongous, 20,400. So is it possible that we do this? Is it possible that, what is it? The dome, as I call it? Yes, it's very possible. And that dome means we're going to drop about 400 points real fast. And then attack some major trend lines. The rising wedge, the lower channel, the red line, huge. Volume still positive. Look at the volume declining. This was the big fat volume on the surge. This one wasn't as big as this one, believe it or not. So in order to have a blow off top, you need to have volume the size of this, to be honest with you. That's a real blow off top. Massive volume, massive euphoria, lots of wowzers. Everyone, not everyone, but traders on our group, very, very happy. That's kind of the signs of a top. All right. And then, you know, so I don't know if this was a blow off top or not, but this was Friday. Lower volume, nothing that low, but lower. This is real low. Just so you guys understand volume dynamics. This is real low, 161 million shares. This was 100 and whatever. You see that. So is this dome possible? Yes. Once you see this dome, things start to get a little bit hairy because the dome is coming off some pretty elevated levels. So all levels are marked. So chart construction in the simplest form, this is one of it. And then you can do one more that I want to show people. Sometimes they ask me, hey, what do you think the stock can pull back at? They can do this on their own side by, what happened here? Oh, okay. By using the Fibonacci retracements. You can just simply pull it down like this, go to the bottom. Well, this is the sort of so-called bottom that we're looking at. Minimize this down. And they can, and Fibonacci retracements are very reliable, just so you guys know that. I've been using it for years, and they're damn reliable. Showed that on Sarepta. Anybody who took that trade is up 11 points on it. And the calls are up a lot more. Okay? And that was a pure Fib retracement play. Of course, you know, also based off the fact that it came off the original levels that we bought the stock on. So the first, why does it? Hold on. I think I took the wrong one because I don't see the 76. Bear with me 1 second.
Which should start from the bottom and go up on this one.
What was that? No,
think he
yeah,
asked
yeah. I just didn't see one of the levels, and I'm trying to see which one is, because I haven't used this for a bit. But I'm trying to I'm wondering. It should give me. When you're looking for retracements, you always start from the top because you're looking to see what the top down is. So the 100 would be the top. And then you can look for it, you know, this is where we're coming from. You can do it both ways, but this is what I'd be looking at. So I'm missing 1 point here, and I'm not sure why. One second.
Try to edit.
Yeah, I know. I'm trying to edit here. Sorry. Oh, No.
No, you had the edit options when you right click on the fib.
I did on this? I forgot. Where?
No, the other line.
Here?
No. Yeah, when you draw from the top to the bottom.
Oh.
This line.
Yeah, so this line, let me see here. I don't see that it function. That's what I'm looking for. Where did you see that it? Oh, there you go. come on. Decides not to do much for it. Okay. Looks like everything is marked.
Maybe
Okay.
change one of them.
Yeah, I'm going to change one of them. That'll work. What is the other one? 73, right? Yeah, 73.
I guess.
Yeah, it is 73 because it's a 23% move down. I mean, on the fibs, not on the market. Okay, bingo. So basically, if you look at it, it comes quite close to what we're looking at, but this is the Fibonacci version. Here's your 100% thing, and generally speaking, you tend to get over a period of time, which can be a month or two, because nowadays things happen faster, a 50% retracement of this entire move. A 50% retracement of this entire move, and I use Fibonacci on Priceline, on so many stocks, right? You guys have seen that, is 19,600, which also happens to be that channel low of where we broke out of. I think we are going to retest 20,000, and it's going to happen rather quickly in the month of April. That's just my guess. All right. So if you want to make some serious money in the month of April, not necessarily have to trade every day. You look for the triggers, look for all my alerts and precision stuff, and then we see some big candle breakdowns. Remember, once you get a big candle breakdown, it doesn't mean it's going to fall right away. Because how many times have you tried to short the market on a big candle breakdown, and then a reversal happens of 200 points, and you're like, oh crap, I just lost my puts. I can't believe this. So you always have to be predictive. And that, my charts and my alerts and stuff will certainly alert that to people. Or maybe I won't alert to people and let you guys decide when to trigger the real sell. How about that? Okay. Just kidding. I'll trigger the alert, but I am not going to walk people through like in, you know, pushing a little baby stroller, because they're going to be very volatile and trying to short, and then all of a sudden there's a reversal, tactical, you know, reflex bounces, things oversold. You have to understand all this. So all the people who are not in advanced coaching sessions, if you don't sign up and really understand the realities of how things work, and I spend a lot of time explaining that, and these people are testament to that, you're not going to do well in the next 2 months. Just letting you guys know. That's just my opinion, because you want to understand what I'm putting through, and you're going to be going in not exactly at the point that I'm saying entry. You're going to be coming in when you're feeling that, oh yeah, the market's now really going to go, because you're just watching prices. And then before that, the market snaps your neck, goes higher, and you're going to be doing the same thing over and over and over again. And many of you have been doing that, and some we have lost a few members who are constantly doing that, despite all I tried to teach and all I tried to help. And good luck to you all. All right. So I mean that in a good way. And from the trader perspective here on the floor, and you know, during the day, the chat room is basically the trading floor, right? And I'm telling you right now, get ready. My triggers won't matter. They'll make you some short, you know, quick money, but you want to make the real money, you got to understand what I'm showing. And you got to be, you know, you got to do what you need to do. So bottom line is, that's basically it. You know, the Fibonacci retracements is showing a big one, but initial Fibonacci retracement is 2,300. And then, of course, we have all these things here. We could bounce off this channel and make another high for all we know. Or we could slip below that, test this rising wedge, kind of move up here, fail, come, and create this big dome. And if this market gets to 20,000, it's a screaming buy for another 500 points or so. If this is the real top, the 21,000 and change, we won't know till weeks down the road or months down the road. That's just the way it works. Any quick questions? Because I got to start wrapping up. I think this has been quite an extensive session. We covered a lot of stuff. And any quick question that I can answer? It's going to be a busy week, guys. Yes.
I just want to ask that the trend on the dollar, does that have much of an effect?
Yeah, the trend on the dollar really at this point, the dollar, I don't have my toss right here. Oops, sorry. What do you call it? My Thinkorswim. Believe it or not, actually, even though my machines are Lamborghini style powerful, I am one of them's at Best Buy right now getting more power. So I don't have my Thinkorswim, which is on the other CPU, but I will put a picture of, we can basically put, that's your Dow Jones. The S&P is pretty much the same story. The IWM is a different story. It's more of a topping pattern. You can see that. The QQQ is see you later. I want to go higher. Just like the S&P, but techs have real juice here, I'm telling you. Just got to play them like we play them. Let's put it this here. Oops. The dollar will, in answer to your question, it doesn't give me UEP. Okay, yeah, so here's the dollar. So, so basically the dollar will only have a real impact on the markets, Jim, if it has an outsized move out of the band that it's trading in. Looking at the dollar here, you can make a determination that this could be a possible cup and handle and that we're about to break higher. And remember, the UUP is the power shares ETF for the US dollar, for people who don't know. So you could draw some lines here like that. If the dollar breaks below the 26 level, this is on the UUP, not on the DXY, which is the real measure of the dollar. This is the ETF. So bottom line is that this is basically telling me that the dollar does want to go higher, but we don't want, and this is the key thing you remember from the old days, we don't want an acceleration of the US dollar past this, past these structural highs, because then you know what happens. Companies are just going to get hurt on their global trade with the currency depreciation on the foreign side, because every time the US dollar is surging, emerging market and our dollar partners overseas are getting their currencies pushed down, right? So it becomes far more expensive for them to buy our goods, the Boeings, the planes, the computers, the you name it, all the stuff that we sell to the world, and it makes us, makes imports. I mean, it basically hurts our export potential in a big way. So that affects U.S. corporations, and that affects the markets. So we don't need this. I think the dollar is basically going to be capped at, what is the, does anyone have TOS open? Where is the DXY right now? Does anyone know?
I didn't open it.
Yeah, I don't have
No,
my
sorry.
TOS open. Somewhere around close to, I can't say the top of my head, what, high 90s? Somewhere around there. So in answer to Jim's question, this can be looked on as a head and shoulder, believe it or not. This is a head, left shoulder, right shoulder, neckline. Okay, if it goes below the neckline, you got to, it's going to come down here. So bottom line is that there are different movements on the dollar, but as long as we don't have a very sharp rise on the dollar, which will be propagated by a very sharp rise in interest rates or consecutive interest rates, which I don't think is going to happen. There will be interest rate rises in March, and as long as they do it on a gradual basis, they're fine. A sharp move higher in the dollar will affect our markets in a sharp way, and in the same way, a sharp move down on the dollar will affect our markets, but in a lesser way. Okay, but I think the dollar is going to be managed between a range. That's my, that's my sort of thing. Any other questions, please? Rip?
What's can you show the chart on Ulta?
On Alta? Okay, one
Yes.
sec. I'm going to change screens. Hold on. Let me pull up Alta. Why are you in Alta? I know it's doing, I mean, seriously.
Everybody buys it.
Huh?
Because everybody buys it.
Well, that's the worst explanations I've ever heard from
All
anyone.
women in America buys it.
Oh, because everybody buys it? Yeah, but my question is, unless, I mean, you want to buy
They
stock.
have earnings They have earnings this week.
There you go. I like that better. We'll be playing earnings. But just because everybody buys it, Alta is not good enough. You know, Alta can drop 30 points too, like it did when people said everyone's buying crap from Amazon, and I said no, that's garbage. You know, you can't be buying I mean, do you buy your makeup from Amazon? I'm just kidding. Let's see here. So let's switch my screen, and let's take a look at Alta. Good question. Thanks for reminding me. So I love playing Alta earnings. Can you see the screen?
Yes.
Okay, great. So here's an hourly chart on Alta, which is basically not telling us much other than the fact that it's range trading. Here's your pivot on Alta, 276, 278. The range is 272 to 278, which really doesn't pay the bills. You know, $6 move. We need bigger one. However, we're starting to see a pattern here, which I think is constructive. You got a nice double bottom. You got a nice double bottom here also on a higher range. This was the previous range, which was 273 to 266. Remember, Alta trades between a 6 to 8 point range. So right now, this is the range. Okay, this is a double bottom. It can be looked on as a double inverse head and shoulders. It can also be looked on as a dragon bullish. Doesn't really fit my definition that much. These things are fine. So we're going to switch over to see what it's doing on the daily to get an idea. Remember, the range breakout on Alta, 273 to 278 is roughly 5 points. Let's call it 6 points to 279. So if on a breakout, you could see the stock basically go to 285. You got it? If you add the 6 or 7 points to it. That's just the way these range trading algos work. So looking at that, let's take a look at the daily, and let's see if we can surprise ourselves by looking to see what it can do. This is certainly a real tradable stock. This is a fantastic looking chart. Okay, period. So at this point, this is the way I would draw it. So bear with me. And I highly encourage all members and free trial subscribers, but primarily members, to post their earnings picks on the trading room so I can look at it and post as much as I can, my thoughts, and which ones we're going to play. I do have a list which I always scan through and then post the ones that I think will benefit everyone the most, and those are the ones that I post. We have had some humongous winners. We have had a few losers too, but we have had more winners than losers on the earnings side. But keep in mind, earnings are pure 50-50 gamble, regardless of what the numbers are. And I highly caution traders to be analysts and try to figure out earnings, because even with earnings coming in lower than expected, stocks can jump, 5, 6, 7%, and that's just the way it is. So let the charts speak for themselves instead of you trying to be an analyst. It's good for you guys to keep your day job, because even the best of the Wall Street analysts can figure out the immediate consequences of a stock move right after earnings. So saying all that, let's draw this out. This is your, this was the, now remember, nowadays, because of the machines, the after hours and post and the following morning movements are very, very, very erratic. Just the way with the, like we saw with the AutoZone, jumped up big, didn't take profits, it ended up pretty much flat. Okay, or the day after. So you just got to do, you just got to respect it. That's just the way it is. It hits that point. Don't sit there thinking, oh, well, it's going to go there, because it's not. Just be smart. So you got to be fast. Try to make head or tail out of this thing here, because it's, as you can see, that it is an uptrend, and this is chart construction on QUODD. Very, very reliable and very profitable for traders who trade technicals. So upper end of the channel, RIP is 290. If the earnings earnings pop does that, it's going to 290. You got a 12-point move on the stock. Okay. I like the nice upward trajectory on the crossover, the 3450 crossover. That's a plus. I like what I see here on the stows, overbought but looking good. Same thing with the this is the slow stows. This is the fast stows. I would say that this chart is not that complex. On the downside, you got support at 267, 50 moving average. You got support at 271, and if all hell breaks loose and they say everybody's buying a makeup from Amazon, because that was one of the fears, right? Which I think is kind of stupid. But let's see here. Horizontal line, maximum damage on the stock could be sustained. That's maximum damage. Alta says that's it. Nobody's buying our makeup. Nobody's coming in. You know, then in that case, you're looking at a 248. Okay, is it possible? All I know in trading, and I've been doing this for a while, anything is possible. Okay, so one way you could do that is you could draw a, well, this trend line is projecting at, 1 second. Okay, beautiful. This trend line is projecting a retest of this broken, this is the uptrend line. I mean, this is the downtrend line, right? The DT line. Broke out of that. A retest of the DT line is 269. So you could expect the stock, this can happen. And it happens all the time. Stock drops 10 points after hours. Everyone freaks out. And then the stock turns around, tests these levels, says, okay, this is the time where we come in and buy. Remember, if you see the stock up 6, 7, 8, 9, 10 bucks right before earnings, the chances are it's going to drop right after earnings before it turns around, because that's the point of maximum excitement by retail traders, and the machines know it, and the hedge funds know it. So, or it can continue higher. Their numbers could be completely blockbuster, and that would be huge. So I could say, let me see here. This is very strong support here. So I'm drawing this as this line. So I could say that if you have options, you might not get paid the next day, because they might bring the stock down here, hold it here, make your options worthless, and then decide to turn around and create a nice mini dragon bullish pattern like this. Or maybe even slip a little bit below 50 just to scare people, and then move higher. Any entry into the upper channel over 285, the stock's looking at 300. End of story. Any other guys?
Can you show Exxon, please?
Yes, that I have right here. Exxon is a slow mover. Okay, the options move nice. This is Sarepta. Big. Just the Sarepta alone, you guys should pay me like $400 a month. I mean, seriously, the type of some of the movers that I give, it's crazy, because nobody said that Sarepta was going to go higher. And believe me, I don't even know what the exact thing was, you know, on their earnings, because I've seen enough earning statements and balance sheets and stuff that you guys could paste on your mansions, all right? And I don't look at them because it's not worth it. So more, you know, it's good for learning, but I learned for 14 years on Wall Street, so I don't need to learn anymore. I decided I will remain clueless and dumb and follow my charts. So Exxon is a mixed story, okay, because this is very oil dependent. This is telling us right now on the daily that it wants to go higher. There's definitely room to go higher. However, there was a bearish engulfing candle, which I do not look at it as a real dramatic situations, because this pattern, in my opinion, and I just told you what's happening with OPEC and Russia and the U.S. oil industry in Houston, I think this is what is going to happen. So on a swing trade, I think it's going to 86. If not, it's going to go to 87. But in the meantime, it's got that chop feel to it, primarily because underlying asset is oil, and political and news flow also affects it. But this is A-okay with me. I don't think Exxon's going back to 80.72 or lower. I think we saw the lows in Exxon, and this long base that we saw here on the slow stochastics is telling us that the bottoming process was done at this level, and at this point the stock will go higher. So that's my opinion. Now, at the same time, you have to keep in mind that this downtrend line here is a key factor. You need a fat bullish candle to break out of this in order to close the gap. I trade Exxon based on my levels. It is still a downtrending Bollinger. It hit the upper end of the Bollinger, had a reversal candle, so I sold a bunch of it 84. I still hold them because they're cheap. Okay, and this is shaping out to be a nice inverse head and shoulder with right shoulder. I call this the right shoulder. I don't want this to be the right shoulder because then it's way too low. Then it becomes a kind of a double bottom. So this is what I see on it. Internals are telling me the stock is going higher. Any more? Jim? Tom?
No, it's okay. I actually had ExxonMobil, or XLE was my question as well, so I'm pretty well set.
Yeah.
Great session.
And remember, this is what I have to suggest to everyone. Everyone. Don't go hog wild on any particular position. Even if you feel crappy because the charts were so right and my alerts were so right and you didn't have enough, don't feel like that. This is a dangerous market. I'm telling you right now. It is a dangerous, volatile market, and unless you're very tactical, very precise, and at least understand, let me do the hard work with the technicals, but you do the hard work of understanding them. You don't do that, you're finished in this market. I'm telling you right now. This is a dangerous market. It can be swayed by one political statement coming domestically or for foreign governments. Okay? This is not a market you can sit aside and say, oh, I have a lumpy position in this and I'm going to do great. No, you're going to be wiped out. Have small to moderate position. If you have ability to actively trade the SPX, the RUTs. Don't hold too much overnight. You can make enough during the day. But you got to be focused on what I'm putting across. Do not just watch prices. Watch the correlation and the interaction of prices and all the other internals that happen. Nothing is guaranteed, and this market is volatile. And this market will wipe you clean if you get too excited over something or you get too depressed over something. On that note, thank you for attending. This session will be uploaded for others to see because I have a important family engagement tonight and I won't be able to do the weekend forecast. But I think this particular ACS, thanks to Jim, thanks to Fish Eyes, Rip, Swimming the Market, and In, has been a fantastic one. Terrific questions. Stay focused, stay positive. We're not going into a bear market, but we could have some swings that will knock your heads out. So just, I will do my best like I always do, and done well in the most difficult markets. So you got to do what you need to do. The rest of you who are not at all, the rest of you who are just have kind of dragged your feet, thinking of doing the group sessions and stuff like that, please sign up. I'll put in my time for the few dollars that I charge to cover the expenses of doing this stuff. Does not make me rich. Okay? So doing this to help you guys do the right thing. Get referrals. See you all Monday. Have a great evening.
Thank you.
Thanks. Have a good Sunday. Bye-bye.
You too.